Welcome everyone. Thanks for joining the second chapter of Financial Independentist. In today's episode, we will be going over Q3 2025 earnings release for Adobe, which was released last Thursday. Why AI is not a challenge to its business model, but an enormous opportunity, and why this solid compounder is a clear buy at its current valuation. But before that, let me share a quick reminder that just a few days ago we published the very first chapter of this YouTube project, and there we discussed how Hims & Hers company is one of the best buys we can do in today's market. Link in the description below. And by the way, if you like this content, please make sure to hit the like button and subscribe right now. It really helps the channel grow and you'll get even better content in the future. Please also leave some comments below regarding this topic or how we could improve future content. Feedback will be most welcome. Alright, let's get on to it. Thursday last week, Adobe reported very strong fiscal Q3 2025 earnings results that beat estimates and raised its full year revenue and EPS outlook. Revenue for the quarter was $5.99 billion, 10% up year on year. This was an all-time record revenue, which beats guidance. Last quarter, the company gave $5.85 billion to $5.95 billion. This quarter, they achieved $5.99 billion. In digital media, the company achieved $4.46 billion, 11% up year on year, again beating guidance. Last quarter, the guidance was $4.37 to $4.4 billion. In digital experience, the company also beat guidance with $1.48 billion revenue, 9% up year on year, versus $1.45 to $1.47 billion. In the bottom line, the company achieved GAAP EPS of $4.18 per share, beating the expectation, which was $4 to $4.05, and in non-GAAP EPS, the company achieved 5.31 EPS, 14% up year on year, again beating estimate of 5.15 to 5.20. Very strong financial results. This quarter, the company posted record revenue, beating expectations and dissipating doubts about potential disruptions from alternative generative AI solutions or other smaller competitor threats. In particular, the company generated over $5 billion in AI-based annual recurring revenue, accelerating monetization of AI features across Creative Cloud and Acrobat, easing concerns about Adobe's pace of AI monetization versus rising competition. The company has been steadily increasing revenue quarter after quarter, without failure for the last 10 years. This flawless execution clearly shows management's ability to capture trends in the creative space, as well as the stickiness of Adobe's business model. About 75% of Adobe revenue is coming from the digital media segment, which essentially is the Creative Cloud, platforms like Photoshop, Illustrator, Premiere Pro, and Acrobat, while other 25% comes from the Digital Experience Cloud, Marketing Campaign Manager, Content Personalization, and Customer Analytics, widely used for customer acquisition and retention. The biggest concern from investors has been related to the digital media segment and how Adobe is facing new competitive threats, challenges to the moat of the company from smaller players like Canva and Figma, the latter of which they were unable to buy. Adobe is also facing competition from certain AI models like Gemini and its AI editing feature, which has been demonstrating capabilities that resemble those from Photoshop and other Adobe products. So, because of this, the narrative has been quite negative on Adobe. Analysts have started to claim that Adobe is surrounded by a host of competitors, which is starting concerns in the long-term thesis. But the numbers are there, and we see no sign of deceleration in the company. Management remains confident in their guidance. This quarter, digital media has grown 11.7% year on year. Quarter after quarter, the company has kept growing steadily and increasing its profitability even further, achieving almost $7 billion in the last 12 months. All margins remain constant and very strong. Gross margin of 89%, operating margin of 31%, and net margin of almost 26%. In addition, the company achieved Rule of 42, a powerful quality metric often associated to recurrent subscription software businesses like Adobe. Briefly, the Rule of 42 is calculated by adding the operating margin, 31.3%, to the revenue growth, 10.7%, for a total of 42%. So, what is actually going on with Adobe? Well, they're not getting disrupted by AI, but rather, they have built their foundation on top of AI itself, becoming the AI Layer 2 play in the creative and digital marketing spaces. Adobe Sensei powers AI-based features across their entire ecosystem, like intelligent cropping and content-aware fill in Photoshop. Adobe Firefly is a family of GenAI models, including a large amount of tools like generative fill, harmonization, generative recoloring, and text-to-image generation. In addition, Adobe has partnered with other third-party GenAI models like OpenAI, Gemini, and Runway. Adobe Creative Cloud has become the default go-to service to all professional content creators, and its mode is so sticky that customers are trapped. For example, it takes a long time to learn all functionalities the Creative Cloud can offer, so once you are an expert on them, then switching cost becomes very high, effectively trapping the users. As a result, companies looking for content creators almost exclusively look for those with experience in one or more of Adobe's products, and oftentimes pay training for them. If we look at the forward PE, we see it's at 16 right now, the lowest it's been in years. In this period of uncertainty and bad narrative, management has been deploying all the company's free cash flow in buying back shares aggressively. This effectively increases the earnings per share, and there will be now less shares outstanding, showing extremely good capital allocation. This resembles the same situation we faced with Google earlier this year, when most analysts were calling the death of Google search and comparing it with the likes of eBay. Until Google proved them wrong, quarter after quarter, we could see a similar story with Adobe. Adobe is yet another example of how an otherwise perfectly valid company gets destroyed purely based on narrative, not by the numbers. Once this bad narrative ends, Adobe is likely going to get a re-rate to a 20, 25, or maybe even a 34 RPE, which is not that crazy for the quality of the company we are seeing. The stock could easily hit $500, $600, or $700 per share. In addition, Adobe management shared a very strong guidance for Q4 2025. Total revenue in the midpoint of $6.1 billion compared with $5.99 this last quarter, a very strong increase. Digital media in the midpoint of $4.55 billion, beating $4.46 this year. Digital experience segment revenue around $1.5 billion, beating $1.48 this year. And GAAP EPS $4.27 to $4.32 versus $4.18 this quarter. Non-GAAP EPS $5.35 to $5.40 versus $5.31 this year. So all metrics, top line and bottom line, increased versus Q3 2025. Adobe management also raised guidance for fiscal year 2025. Total revenue was increased to $2365 to $2370 billion, up from $2350 to $2360 billion from the previous quarter guidance. Both digital media segment and digital experience segment revenue have also been increased from the previous quarter guidance. In addition, bottom line GAAP EPS has been increased to 16.53 to 16.58, up from 16.30 to 16.50, substantial upside. And non-GAAP has been increased to 20.8 to 20.85, up from 20.50 to 20.70. So management has raised guidance in both top line and bottom line, and in both segments. The company is firing in all cylinders. So, what is my game plan with Adobe? Well, Adobe is currently 1.05% of the Independence Fund, so it's not a very large position, at an average price of $405 per share, which means we're currently a bit down, but we don't see this as a big concern as we remain confident in the company. Our current plan is to continue buying while the price remains under $400 per share. As we see it, the company has been badly beaten down recently based on nothing, and numbers continue to support the long-term investment thesis. So, we see this stock as a clear market overperformer. From a quality standpoint, we have Adobe rated as a quality growth A company, which is the status of a premium company in which we have full confidence. Lastly, let me remind that this content is not financial advice. Please share your comments about what you think about Adobe and what is your game plan with it. Please also let us know how we can improve this content in the future, and don't forget to like and subscribe. Thank you very much for watching, and see you all in the next episode.